In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. So most of my videos are recorded and scheduled the day before and uploaded for the next day. For 5 days out of 7, it's a trading day, so of course by the time the video goes live on my channel, the price would have already evolved from there. If there are significant and very volatile movements during the trading day, obviously they will not appear in the video on that day. But usually, to the extent possible, my analysis will be based on the medium term and not really focused on the intraday movements. The reason why it shouldn't matter that much either way is because most people investing in stocks invest for some kind of reason that takes time to get developed, and that their positions are usually kept for at least a few weeks. With that being said, if there are significant stock price movements that happen afterwards, either they will not affect the overall picture, or if they're significant enough, they will be mentioned in the next video about the stock, with re-evaluations of the circumstances as needed. Sofi operates in the financial services sector, or more specifically, fintech. It provides the services of loans, refinancing, and credit cards, as well as wealth management solutions. It is a company based online and separates itself from the conventional banks mainly from the difference between physical and virtual operation environments. Its appeal to the investors is the massive user base subscribed to its platforms, consisting of a large pool of potential clients, contributing to the fact that it may be growing very quickly, and in the number of revenue streams. Sofi benefits from famous investors who are almost perceived as superstars in this day and age, and the fact that after years of discussions and speculations about what we would like to call a lightweight bank, because it's now mature enough to be deployed to consumers at large. The market cap of Sofi Technologies is currently at $13.4 billion, and the enterprise value is at $15.2 billion. The market cap is the price financial market is willing to evaluate Sofi stock at, with considerations to its future potentials as well as the short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually the market cap is higher than the EV, but sometimes there may be exceptions. For example, the company may be highly leveraged or under a lot of selling pressure. The quick ratio of Sofi is 18.3. Same goes for the current ratio, and the debt over equity is 0.66. So I would say that it does have a significant amount of debt, although all things considered, it won't be a problem in the long term. The average trading volume of Sofi Technologies has been 35.5 million shares, and the daily volumes have been 30.7 million shares, 34.1 million shares, and 64.2 million shares. The one-year beta of Sofi has been 1.04. Its 52-week high is $28.28, and the 52-week low is $10.75. Now, let's also talk about the options market for Sofi. In terms of volume and open interest, the options market seems to favor the call side. Generally speaking, the put options mean that the market expects a pullback or downward pressure, and the calls options mean that the market expects the prices to move up. The key strike prices where there seems to be the most interest are $16, $16.50, and $17. Sofi has been one of the more popular picks for retail traders during the later parts of 2021, and that is partially because they obtained a bank charter from a previous merger. The market began to turn after the peak in mid-November and started to pull back from this point onward. There may be several reasons why it was the case. Shareholders may be taking profits from their positions before reevaluating what should be the next step, simply from a risk controlling perspective. Another reason may be the fact that the market sentiment began to turn regarding the fintech industry and the growth stocks as a whole. Actually, we can't really call them meme stocks because that's another thing, but let's call them the narrative stocks. The stocks requiring people to believe in the story those companies are telling them. For a good portion of 2020 and 2021, this has worked to various degrees, but there was a lot of people willing to believe them. It is possible that the market has begun to take a safer approach overall regarding choosing stocks. Let's keep in mind that Sofi has maintained excellent results despite a wider market context that is now more difficult and has been able to pull through a massive redemption date. Those are positive signs in my opinion, and they may be signs that the biggest part of the pullback may be behind us. This also means that my advice regarding Sofi has actually been the right one since the beginning, which is to keep a foot in the door and to wait for pullbacks. The pullback definitely happened, and I would say that now is a good entry point to get in the stock. My recommendation is to keep a position between 1 to 3% of your portfolio in Sofi and to buy at least 50% of your allocation right now. The short-term profit target should be around $25 like the previous peaks. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.